Ladies and gentlemen, welcome back to the FinStep Asia Token Bytes. We are here at Money 2020 Bangkok. I said 2020 a lot of times, but yes, here we are. This is my third time here, and it's quite exciting. What we're seeing this year is this overlap merger of traditional finance with decentralized finance, and a lot of interesting companies here. With me is a friend, Geoff McAlister, CEO and founder of MiPool. We will go deep dive into what MiPool is doing, but we'll also have a conversation around how a banker turned DeFi person is now become an entrepreneur, and what he is building to bridge TradFi with DeFi, and how that is going to be potentially one of the major things that we see being driven in traditional finance and the evolution of money. Geoff, welcome to Token Bytes.
Thank you, Musheer. Great to be here, and Money 2020 Bangkok is certainly an impressive event. It's really good.
And we've done now this with the two of us. We were in Hong Kong together, then met back again in Dubai when I was there on the other side of the channel, and then here we are meeting here again. But Geoff, as I was talking to the audience, you've had a distinguished career, if I may say so, working for some of the top banks in the region, both in the ANZ, but also Hong Kong and the Middle East. So you've kind of seen the whole gamut of Asia. Tell us a little bit more about your career. How did you get into finance, and what do you enjoy doing, and how did you get into risk in particular?
Sure. Yeah. I guess I would frame it as a long career, but it's been really good. I started with Westpac in Australia. Yeah. In working with Westpac Treasury.
Sure.
And
have some water. Yeah.
After 4 years with Westpac, I moved to the UK.
Okay.
And I worked with various large banks in the UK, including Citi and RBS as well. I was fortunate then to go to New York with RBS, and this was all following Treasury. It was mostly risk and markets risk focus, and then moved on to Goldman Sachs for a while, and then eventually finished up my TradFi career as a chief risk officer for a small bank in Southeast Asia, and then moved into crypto in 2021.
So you were in Laos at the time with the bank in Southeast Asia?
Yeah, absolutely, next door.
Yeah, and how was, I know you've gone from like one end of APAC from Australia, then you went to UK, and then you were in Asia, but how have you seen, I won't dwell too much on this, but culturally, how have you seen the different, and you also work for retail banks, commercial banks, but then a very high-end, sophisticated investment bank, which is a very different culture. So what have been that nuances you've seen as differences, both culturally from a region, but also from a work perspective?
Yeah, it's been actually very interesting. The very well-established developed banks. They have the benefit of being in the business for 100+ years. Some of them like 150 years, and the processes and the knowledge is institutionalized, and it builds up over that time, and it's surprising how much that you sort of absorb that is built up over all that time. And then moving to newer, younger, less developed banks. For example, I moved to Abu Dhabi in 2012, and that was really working with a bank that was really growing fast and rapidly and becoming very much a global best practice sort of bank. But it was lacking that 100 years of sort of experience. But they sort of brought that in, and it was very much a building job. So working for the newer banks is actually kind of a bit entrepreneurial, because you're building.
Correct.
You're building. So it's actually, I found that more interesting in many ways.
And again, this is one of the things that people sometimes forget, that banks are also of different sizes, shapes, and age, right?
Yeah.
Quite a few times there is this conversation around entrepreneurship and being entrepreneurial, but there's also entrepreneurship where when you are, and that's something I've had as experience, is joining newer teams or younger teams, and then you're growing, and it's very entrepreneurial, and you of course you have your governance layers and decision layers, but still in terms of building you do have that flexibility to own it, right? I think ownership becomes significantly more in that case,
definitely in the newer, younger banks there's a lot more opportunity to own it and bring your experience from other places
over. And how did you bring that experience from banking into digital assets, crypto, blockchain, whatever you want to call it now? I mean, it's all merged and blurred, but what attracted you to at that time, the crypto rodeo? Although the firm you were with, you'll talk more about it, but they went in the rodeo, but
So, no, look, I became interested in crypto sort of pretty early, but I didn't step in until like on a permanent basis until 21.
Sure.
I started on a personal basis playing with it a little bit in 2018.
Okay. The ICO boom times.
Just a little bit. But I mean, I found, so initially with Hex Trust, I was head of group risk.
Yeah.
And in terms of bringing over from TradFi there, it was probably, risk appetite sort of framework and defining these kind of things. And then I was head of markets as well. And again, it was sort of bringing in some of that sort of institutional structure and discipline, I guess. Yeah.
And what are your general thoughts on, digital assets? The key differentiator you saw from, like, I'm not talking about the culture, but from an asset perspective, operational perspective. Hex Trust at the time you joined was primarily a custodian, right? And then when you became the head of global markets, was expanding into broker-dealer and other elements of the capital markets world and digital assets. And how did you see that move? Right, custody is a very strong, highly governed, highly restricted, and it's almost like one service, one product. And then you go into global markets, which has a very different, goes back to the more so traditional finance investment world in some senses. So.
Yeah, look, I mean, firstly, the 24/7 broker-dealer service is a very real challenge. To manage the resources, to manage the team across 7 days, so that so you're replying to a client within a minute.
And they expect you to
24/7,
right?
100%. So you've got to be staffed and rostered, so people still want to get 2 days off a week.
Correct.
But it might not be Saturday, Sunday. It might be Tuesday or Wednesday. But that's actually something that banks are not used to managing.
Very true.
So that's something you have to sort of work out.
Yeah.
Everything else, there's a lot of similarities with the global markets business in traditional banking. Products, clients, services. It's in the end, it's about serving the client and delivering the best product that suits them and the best execution you can manage.
I think that's also, you touched upon the term best execution, and while when I was part of the team at Wara, and when the rules were being built out, one of the key elements was bridging this governance, good frameworks that exist in traditional finance, which have been lessons learned. Sometimes we feel, a lot of the crypto was very opposed to the way traditional banking works, and legacy saying it's very old school, it doesn't fit in here. But there were all these things with regards to, like, best execution, a classic example that's been learned over decades of saying, okay, how do you do the best for your customers and users? Ensuring best governance is best execution. You have to find it, and that's a fiduciary duty and a regulated duty for you, which has now been brought into crypto as well. Earlier, it was not necessarily, it was more self-governed, let's put it that way, but now it is a regulatory requirement as well, right?
No, it's essential. Look, I mean, I think I was excited to move into crypto, and I knew it was a young market, but I was still, fairly surprised at still how immature it was, especially in like 2022, when people were falling over left, right, and centre, with basic things that they weren't doing, right?
And most of it was risk, right? And we're talking about Terra Luna to begin with. That's where it's about not managing or projecting what risk could be there and the impact thereof. So a bit of hubris, a bit of mismanagement, and then subsequently FTX with governance, and again rolls into risk. And you've been in risk for a while. And how did you build that framework in Hex Trust, but also we'll talk about MiPool very soon. But how did you build that into say, okay, the regulations are at X, but in reality you need to be 2x, 3x of that. So how do you build the and just as an addition to that, we spoke about 24/7. In traditional finance, it's in most cases it is at best 23/5, and I'm talking about the futures world and like CME and ICE and etc. who do operate 23/5 or 22.5 to 5. But none of them are up, and maybe FX markets is the closest you get.
6 days a week.
6 days a week. So you still don't have it. So how do you manage this risk at all times of? And especially when you're in one region and can have because the same product, unlike say you're trading something in the US, so US product may not impact Asian markets and vice versa. But this is a product that has roots globally, and it keeps going 24/7 in most of the major crypto activities.
For sure. So no, there was a couple of points there, but and actually, I mean, I was bringing in what I had experienced and learnt from the TradFi world, and what I had implemented there in terms of defining a risk appetite and getting that sort of the framework and the boundaries for the firm's appetite. So like approved up front. And so that you know what the rules of the game are and where you can play, and then when you need to, for a client, sometimes you need to do a bit more than what's already agreed, and there's a clear escalation route in terms of how you get that approved or not. So that's important, and that's something I'd implemented at other banks in TradFi. In terms of running the book, a global book, again, it was very much something I'd experienced way back at Westpac, on the FX desk at Westpac. Again, it was a 6-day book, if you like, but that global book where you hand over from one desk to another desk in another region to another desk, and there's a handover process, and so literally just sort of implement that within the markets business. So you hand over the ongoing trades and orders that are being worked and the status, so that there's like a formal handover process from each shift to the next shift.
And I guess that's now what we're seeing as a move is earlier predominantly when you were dealing, and correct me if I'm wrong, but it would largely be crypto native funds, crypto native trading companies, etc. Not too many traditional finance institutions coming in, but now you're seeing that merger, and we'll come to MiPool as well on that. And so how are you seeing that evolution of blockchain, digital asset based products in entering into the merging with it? I won't even say enter, I think it's merging with traditional finance. Convergence is there, and there's probably elements of regulations, but there's also the McKinsey report when looking at the banking, the annual banking report, which is a must read for those who don't. It gives you a very good outlook of global banking status, but also trends. Would love to hear, and I know you do have some points around that, but so how are you seeing that convergence, as you rightly pointed out, and what are the numbers we're seeing as well?
So look, I'd say convergence is 100% the right word. The McKinsey Global Banking Annual Review, as from 25, as Musheer said, as you said, it's a really good report. I mean, for MiPool, it's sort of uncanny how it aligns to what we're doing, which we can go into a bit later. But I've always believed, for many years now, that the whole value layer of the economy is coming online via sort of blockchain DLT enabled infrastructure. So that the whole value layer is coming on, like everything. So I've been sort of a big believer in that for quite some time, and and I was surprised to see that no one was really tackling the mortgage market, and which is a huge market that will benefit a lot from the efficiency gains of coming on chain. And so that's what we're doing now. But it's the whole value layer is coming on.
And if you've converged this, and you then took the plunge into entrepreneurship, you've been entrepreneurial for a lot of your career, as you've mentioned, and when you're working for a growing startup now, a pretty big scale up, that's also a lot of leadership and entrepreneurship. But going all in on your own, right? It's a bit like, as I said, jumping into the pool the first time, or you may have been like
into the deep end.
Into the deep end, yes. I don't swim, but I just float about. But how was that? How did you take that plunge, as it were? Yeah.
Look, the opportunity is just too good to ignore, and there's so much benefit that can be gained by doing this.
Yeah.
It's important to have strong support from the family.
Agreed.
Essential.
Yes.
Hat tip to my wife. so that's critical. And it's great to be in a position to take this forward. Yeah.
And how's that experience been so far as an entrepreneur?
So,
building an idea.
I wouldn't change it, but
sure.
It's certainly comes with some frustrations in terms of you want everything to happen sort of yesterday.
Yeah.
and things just move slowly, right? So especially, when your clients are large financial institutions, effectively, those conversations and getting to the right people in the organization to get to the decision makers is obviously, takes time.
And playing on the pun, Xiaomi is little rice, right? But here we have MiPool, which is not MiPool, but it is again bite-sized mortgages, and
yes.
In a way, right? But would love to hear what is MiPool and what are you bringing to the house, as it were.
Yeah. Okay. Thanks. I'm sure many people in Europe will probably call it MiPool because that's what Europeans do.
Yeah.
But MiPool is mortgage investment pools.
Okay.
So we're working with banks to tokenize mortgages to enable them to distribute those assets on-chain so they can recycle mortgage capital on-chain. So our MVP is effectively a Web3 alternative to the mortgage-backed security.
Yeah. Now I'm going to bring three things and we can go one at a time probably. I think the first thing is for people to kind of understand how is this structured as such, right? This is Web3, is it crypto? Because quite often when we talk about tokenized assets, people mix the two or confuse the two, say Bitcoin versus real world asset tokenization, which is what you kind of doing. So one would be, let's start with that, and I'll follow up with a couple of other elements about the model and structure.
Yeah, I mean, so real world asset, it's I mean, people refer to CDeFi. I mean, you might call it hybrid DeFi. I mean, it's not DeFi. It's very much sort of gated, so for professional investors.
Yeah.
Okay. There is a way that retail will be able to participate via licensed regulated funds that invest across the asset class.
Understood.
Right?
Yeah.
But that's a later step. It is not DeFi. It is very much a infrastructure layer, orchestration layer to support the banks and enable them to manage this asset class on chain. So there are some autonomous components. We have a proprietary engine, Wade, our waterfall automation disbursement engine.
Nice.
And so that manages a lot of the lift on chain because as you mentioned with the Xiaomi little rice analogy, the mortgages are being tokenized, but they're also being fractionalized. So for every dollar of principal that's outstanding, there's one mortgage participation token minted. So you can have basically sort of a syndicated loan format where 10 investors can buy 10% each of the one mortgage.
Sure.
Or you can have a fund that can buy 10% of 1,000 different mortgages to get a nice diversified portfolio, and they can construct it with specifying their risk appetite or in terms of LTV, duration, yield, geographic distribution, and borrower profile, and so on. Yeah.
So it's all modular blocks that people can pick and build, right?
Yeah.
So, and just for the audience who are not as familiar, Geoff made a very important point about tokenization and fractionalization, right? So when we're considering real world assets or any assets that are brought on chain, meaning representing those assets on the blockchain with investment rights, potentially legal rights as well, depending on the regulatory framework, that's tokenization, step one. Now that can then be broken into multiple parts. That's where fractionalization comes in. But it's not necessary that all tokenization leads to fractionalization, but all fractionalization of real world assets on the blockchain is tokenization. So you could have one full mortgage without breaking it up as one single token if someone wanted to do it. If you wanted to do it. And now, why would somebody want this? Why? Okay, so the second question was, I'm not going to play devil's advocate, but I'm going to bring in the question a lot of people have, which is, I started my career 21 years ago as a trader in futures market, trading Eurodollar futures. That does not exist anymore. Largely, it's a futures for figuring out the US dollar overnight trades, right? They've renamed that now because of other reasons, but that was one of the largest interest rate markets in the world, which determined the base for mortgage rates, especially in the US, and mortgage-backed securities and structuring of that, and then basket, putting them in a basket and selling them has been largely credited with causing the global financial crisis. Because of the way it's illiquid, there's a bunch of different things, right? Yeah. So when people look at this and they're like, okay, you're packaging them together, then you are tokenizing this. Are you making it more complex? Do people understand this? Is there a chain effect if people start selling this? All these questions come up. So it would be great to hear. And you were at the thick of it at that time as well. So you very well understand where people are coming in. And everything digital assets usually seen as more risk, higher risk. So how does that very differ?
Completely. 2008 was interesting. I was at Deutsche Bank in market risk at the time. So it was certainly an interesting experience. But I mean, I would take some issue, and I know a lot of people kind of point fingers at the mortgage-backed security process for 2008, but it was really, before that. It's kind of crap in, crap out, right? So it was the ninja home loans that were really the problem. I mean, the fact that mortgage-backed securities enable banks to package mortgage debt and sell it and recycle capital is been a really important innovation to support banks in capital management. And I mean, it's still a super important market. Like today in the US, you have about 1.5 trillion a year in new mortgage-backed securities issued every year. So it's not something that has gone away. It's still a critical piece of the banking market. But it does have a lot of room to improve. And one of the issues back then was, and it still is today, is transparency on understanding the performance of those mortgages in that basket that's been securitized. And maybe, I don't know, so just to quickly go through that process, the banks, the traditional mortgage-backed security process is batched. So you have to basically build up 500 million or $1 billion worth of mortgages to make it worthwhile, because it's expensive. And that takes time to build that up, and then establish a dedicated SPV for that particular batch and governance around that, and then issue the securities and distribute the securities, so there's capital sitting on the table for this whole time, and it can take sort of 2 months up to 6 months to originate and distribute these mortgage-backed securities, which is capital sitting on the table. So that's sort of one area that can be addressed to compress, is to reduce that time. The other area is cost. It's quite expensive over the life of the asset.
Yeah.
And it varies from across the quality of assets, but it can be sort of, towards 200 basis points over the life of the weighted average life of the securitization structure.
And I'm going to build on that transparency piece, and then that's what blockchain brings. But of course, there is ways of masking personally identifiable information, be it for institutions or individuals.
Yep.
But you do see transactions happening, and you get at least a look at what are those mortgages, what do they represent, and it's real time. Everybody who's involved in the process probably will have that, not necessarily outside. Now, there were two elements which besides crap in, crap out, as you put in, SECO, we can call it that. The other challenges that we saw with MBSs in general, and on top of that was CDS as well, collateral debt securitization or securities.
The credit default swaps.
Credit default swaps.
Yep.
My trading is getting away from me. Thank you for correcting me. You had the swaps on top of that to cover the risk. It was liquidity, right? And one of the major elements, or some call it a challenge, some call it a hurdle, some call it market reality, is with many real world asset tokenization, be it bonds, be it property, etc. I will talk about the legalities and other elements first, but second, the major challenge seems to be the primary market's fine. Like when you do the primary issuance, it's people are looking at it as purchasing the underlying, right? So property, yes, we'll purchase it. It's primary. The people who are real estate investors will be interested. Others, challenge starts coming in for the secondary market, right? And that is where the capital lock-in is solved to a certain extent. You fractionalizing it. So, more liquidity at issuance. But what about the secondary market? So how do you see MiPool's tokenized mortgages, and for investors who purchase these, what is the pathway to a fairly liquid secondary market? Because when you don't have an active secondary market, and if there is pressure in the market due to various reasons, that's what happened. And Lehman essentially had a lot of assets, but they were not liquid enough for them to be able to fund their margin calls, etc. in time, and that's led to the bankruptcy and then the whole chain reaction, right? And then the market just crashes. So how are you seeing the evolution? I'm not saying it's there yet, but I do want to think that'll be a concern that people will want to look at.
I think obviously in crypto we're used to seeing sort of liquidity challenges and massive price drops. That
swings are massive,
which can be pretty crazy. I think with the RWA space, at least if it's properly structured, they are anchored in a real world asset which has real world value and depending on the asset, real world cash flows, right? So to the extent that they become liquidity challenged in the market, there's a huge opportunity for market makers to come in and put a little bit of balance sheet on the table and support and buy at a discount these sort of mortgage participation tokens. So,
and how would the banks manage their risk? You had credit default swaps. Would that still be something that would happen now for MiPool based mortgages? When somebody else say, it's always a lot of banking products or investment products have two sides. So most people think it's only for the upside, but typically there's a coverage and there's a hedge, and that's why you have insurance, as it were, right? A hedge is an insurance. How would people, and my understanding may be limited of that space per se, but how would people cover their liability and get this hedge if they need
on the credit risk?
On the credit risk, or would it be still the underlying standard one that they had from before, or would they be you envisage a newer evolution?
Most of the credit default swap market was sort of really, I'd say, largely on named entities. I don't know to hand how much of it was on individual mortgage-backed security issues, but certainly, in terms of the bank, I mean, they're selling the exposure.
Correct.
So the investor who buys the mortgage participation token
correct,
is buying the full economic performance of that asset. So that means prepayment risk. So if somebody prepays the loan early, your duration is suddenly sort of reduced from, you might have expected it to be longer, is going to be reduced. But having said that, you also receive the prepayment fees flow through, right? And then the default risk, to the extent that there's a default in one of the mortgages, then the investors that's holding the mortgage participation token is on the hook for that default.
Correct.
They do get a governance process where they become the title holder of the underlying collateral via a deed NFT, and then they direct the workout of the loan and the liquidation, or actually the pool holders can even decide to extend a grace period as well. But you have the full economic performance, you own it, and to the extent that there becomes distressed assets, there'll be a market for distressed assets as well, which again is another really interesting opportunity for market makers, for an asset that is anchored in some real world value, right? Even if the cash flow has temporarily stopped because the borrower's in trouble.
And you touched upon the legal deed as such, right? And it's one of the elements a lot of people talk about when it comes to tokenized real estate. Let's just stick to that for now. So you have as long as the transaction is on the blockchain, right? I wouldn't say digital, I'm going to say on the blockchain specifically. It's all fine, you settle it, you get things done. But now there is this off-chain element, right? Which is two parts. One being, where are you seeing, and Dubai's been running a bunch of POCs with Dubai Land, working with Vara and a couple of players in tokenizing properties, and then of course bringing in the legal framework that supports that digital twin, as it were, of that property to be, because here it's mortgage is a layer above that, because you first is the investment liability, and then but typically the mortgage is backed by the underlying home, right? And that's, if that value changes, etc., when something is distressed asset,
the LTV changes,
you have to sell the property. So what, long story short, is there now a ability for saying this, say a fund comes and buys a whole MiPool of an area, a block of towers, right? Which have about 1,000 mortgages per, say, 1,000.
One suburb or something.
And then they're selling that to their investors from additional investors, LPs. But in this case, the mortgages go bust or whatever, right? So now will they get legal ownership of the property on chain? Or I mean, on chain, yes, probably. But what happens off chain? Is that we seeing the legal framework ready for that right now, or it is then you're just a joiner to the claims on the once it's sold and it's somebody else who owns the title deed, as it were.
So I won't.
Sorry, I'm getting too maybe a bit technical.
It's fine. I won't go into the full nitty gritty of the complete detailed structure, but I mean, the UAE is a really good sandbox for this, because as you know, and we're also partly responsible for the regulatory framework in the UAE is quite advanced. I guess I would say the most advanced in the world. And there's a number of options. There's VARA, there's DIFC, DFSA, and they have a sandbox environment, ITL, the Innovation Testing License environment, and then there's ADGM and FSRA, right? And then there's national regs coming
CMA,
in as well now, with ESCA and so on. So I mean, we're kind of blessed with a few different paths that we can decide to employ, and so the framework is is ready, and the legal structure. I mean, DIFC is obviously a world-renowned market with an established legal framework that is
it's common law framework,
very close to English law. So it's a perfect place for this sandbox to happen, to bring mortgages on chain. I think, So
it's evolving. It'll probably come in soon, but a lot of it is going to be digital asset based. Transfer of ownership and liabilities to a certain extent. I know, look, a lot of these models are things people wouldn't have thought about 5-10 years ago. And there is this evolution. It's something very important is as you evolve, the structures also come in. Foresight is not always going to be possible because a lot of time with regulators, and especially when they're very established regulators, people forget that it takes sometimes 2, 3, 4 years for a change in law. So when there's here's an innovation that's coming up, they can think about approaching it, but changing the law won't happen till they actually see practically. And I think that's where the rest of the regulators are evolving, and we'll see more conversations around it. I want to take this forward in terms of what next, right? In terms of MiPool, how do you see MiPool? How do you see? You've been speaking to some large financial institutions as well, both in the Middle East, UAE in particular, but also here at Money 2020 having these conversations. Without naming the bank, a very large bank, yesterday when we bumped into them, I actually found that very refreshing, where the person, when they heard about what you were doing, they were like, this is very interesting, let's have a chat. They're a very traditional bank. Yes, they're doing a bunch of tokenized stuff, but for that very openness to have that conversation, for me was a wave change to even 2-3 years ago. Right?
It's impressive to see, actually, isn't it?
I also attribute it to regulators, in particular in the region, Hong Kong, Singapore, UAE, who have shown the willingness to put time, effort in understanding these products and building regulations around it, right? Which then encourages traditional finance participants to come in because they're regulated and they need to touch only regulated elements, largely speaking. So how are you seeing as you go into these conversations, what are they loving about it? What do they want changed about it, possibly?
Okay. So I guess if you're not early, you're late. So you're 100% right. Sort of 5 years ago, even sort of 2 years ago, I'd say the market wasn't ready for this, but I think the market is ready now. I mean, we're certainly probably early, as in the only project I know that's working on this at the moment. But if you're not early, you're late. So I think we're getting the timing right, and you saw some of the traction with that bank being very interested and open and happy to take it forward to explore, and that's a big traditional bank. In the UAE, the banks, again, I would say, are quite progressive with looking at digital assets and digital asset solutions. They've got many live use cases. There's multiple approved regulated stablecoins in the UAE. There's multiple banks that have crypto trading via their wallet, right? Via their mobile banking app. So they are quite advanced and forward-thinking and forward-looking, and I would say, hats off to them. They're moving compared to other global banks at a pretty good pace, and there certainly has been some strong positive interest in that. We're in sort of fairly deep structured discussions on the pilot now, and looking to identify the bank that will join a pilot where we tokenize $50 million of mortgages, and then they'll be sold to a tier 1 global investment manager that we're talking to, and managed across MiPool in terms of the loan orchestration and lifecycle management. But so it's slower than we would like, but they're 100% really interested and going through a very full formal due diligence committees all the way to look at doing this.
Much faster than we used to see fintech 10 years ago, right? Where it would take a year, 2 years just to do due diligence. But now you're seeing at least the structures are all in place, thankfully, due to what fintech brought in, where you do have the structures.
You're right. Yeah, they've got these kind of innovation labs established and teams that are established to look at and assess these kind of projects.
Correct.
But I've certainly seen some you saw the interest from that one big bank.
Yeah.
I saw some strong interest today from a bank, Philippines bank. Yesterday.
Yeah.
And also from another, from a large American bank yesterday as well.
Okay.
And we're also talking to a large UK bank just to very early stage. But there's interest. There's definitely.
Yeah. Okay.
I think the time is right. There's appetite. Having said that. There's also the non-bank issuers, so the sort of or fintech mortgage providers,
or even just the pure home financing, home loan.
Exactly
markets.
Right. Yeah. So, and a lot of these guys, at least in the US or in Australia or Europe, they do have the model to originate and then distribute, just to originate, distribute.
Yeah.
And so we're going to start talking to these guys soon as well.
Okay.
And I expect they will probably be a bit faster to move.
And I just reiterating the point, and correct me if I'm wrong, essentially when it comes to MiPool, you're the infrastructure layer for tokenization of the mortgages. This is the mortgages owned by the banks, sold to professional investors. MiPool is not the investment platform per se, it's white labeled. Or it's the infrastructure layer.
Yeah, you can think of it as a loan management system on chain that orchestrates the or on-chain servicing platform for automated servicing platform for the tokenized mortgages and the whole life cycle management.
Sure, yeah.
So, but there's kind of a bigger picture that's moving to, and that is basically lifting up what I call isolated, repetitive infrastructure that exists in every bank.
Yeah.
That in this case is a loan origination system, which is the whole life cycle management of the mortgages, for example.
Yeah.
But lifting this on chain basically enables it to become a shared infrastructure for the industry, right? So, and I think this is a theme that will happen going forward, that a whole lot of the guts of the internal IT infrastructure and platform solutions within a bank don't need to reside entirely within every single bank. They can be lifted up on chain and become shared infrastructure for the industry.
I think it's an important point. You will see a lot more of these shared services, and you of course have the challenges of cross-chain management, which are all coming in, evolving in parallel. So before we close, if you had to say in 3 years' time, where do you want MiPool to be, and where do you want the ecosystem to be with MiPool?
Yeah. Okay. So basically, the MVP, which is the Web3 mortgage-backed security equivalent, in 3 years' time, will be live and running in the UAE, and a couple of other markets, including the US. That's the MVP. Then there's the MiPool Core, which is the full loan life cycle, which enables primary loan origination on chain, where the bank can use its tokenized deposits to extend to its client a mortgage, and so the bank retains all of the client-facing and relationship. It's just using the platform as infrastructure to extend its tokenized deposits to fund your mortgage. So that'll start happening as well by then. That should be live as well by then. And ultimately it moves to, like, for bank capital management, going back to the McKinsey Global Banking report from last year, where they really focused on precision capital management. And MiPool enables exactly that for the mortgage book, that we basically have programmable mortgage assets, and this will ultimately lead to programmable balance sheets.
That is an exciting element. Look at programmable balance sheets.
Yep.
It's a way we are moving forward. As I say, it's the convergence, the blurring of the lines, and the way forward. And as I've said recently, for a lot of things in finance, most people look at like a watch, 3 hands, don't understand there are hundreds of parts underneath, or maybe are not very aware. And the same thing needs to be for use cases when it comes to blockchain. People don't need to worry about keys and phrases and cross-chain, etc. They just need a product at the end of it.
That's right.
That's what it matters. You had a more, if I can use the term, mechanical watch, and then you have Apple Watches still shows time, and that's what they want. So show us the money, as it were. Geoff, this has been a fascinating conversation. Thank you so much for joining us, and we will have you back in a few months' time for sure to know what's been the progress, and not just with MiPool, but how is the industry evolving on this. So bite-sized mortgages, it is in tokens. Thanks once again. Ladies and gentlemen, follow us for more such conversations from Money 2020 and beyond, as we bring in founders and CXOs who are at the cutting edge of finance and money, and to a certain extent AI as well. So from Bangkok, signing off. Click like, follow and subscribe on our channels, and thanks once again to our guest, Geoff McAlister.
Cheers, Musheer.
Thank you, Geoff.
Thank you.
Thanks.